You clicked on this video because you want to know how I made £5,000 on one trade on one trading account. I'm Jack Beanie, the main trader for the Limitless Trading Club, and I've been a trader for over 7 years now. I'm going to break this down in 3 easy steps so that we can keep trading simple. So before we get started in part 1, let's go over the currency pair used. That was NZDCHF, and we used one of our £100,000 personal trading accounts, meaning we had £100,000 GBP in this trading account, which was our personal funds. This was not a funded account. From there, we only risked 1% on the trade placed, and we was trying to gain 5% back, or £5,000 on the setup. And this was using one of my 2 strategies. This was using the MSBC, which follows on from the MSB. So let's get stuck into how we made the money. Part 1 is we needed a proven strategy that worked. So I had a proven strategy that I had passed down from a mentor, and that's the strategy that we used. So if you need a strategy, you need to find one. Once we've then got a proven strategy, we now need to know how to use that strategy to place trades and also to be profitable. So you need to put time into understanding the strategy and also back test that on all different currency pairs. So let's get onto the charts, show you how I made the money. So as you can see here, we've got our watch list on this side. I have a small watch list, and then we go into some of the cryptos I'm looking at, and we are on NZDCHF, as previously said. So let's hide that out of the way. We don't need that. It's just creating a thing. So first of all, for my strategy, I need to do support and resistance on the weekly or daily time frame. So you can see I've moved stuff from on where it was. We have got a weekly zone that come right through here. You can see with this previous test, this at the minute is the lowest it's ever been on record. Price is moving downwards in a big channel, and it has done that ever since the market's open. So once we had our weekly zones marked out, I then had to look at for some structure, normally on the 4-hour time frame for my trading strategies. So when we jump down to the daily time frame, you can see we had a big head and shoulders formed here. We drop down to the 4-hour time frame and give us a better look at the head and shoulders pattern itself. So this head and shoulders pattern was from the end of April and start of May is when this head and shoulders pattern was formed. So I'll mark that out now. So now that we've got our structure in place and our market structure, which is a 4-hour time frame head and shoulders pattern, I have 2 strategies. Strategy 1 is trying to catch from the right shoulder down to the neckline, and then from there is from the neckline down. So we're after the 2 pushes on the Elliott wave system. So what we then had is we had a very long time that I wasn't able to catch any trades due to price not pulling back into the 4-hour 50. So price did break here and pull back into this area. This trade was missed. From there, we then looked to grab a trade on this downwards movement, which we never got the big enough pullback. Price did nearly come into here, but until it touched the 4-hour 50, I knew that price had not exhausted enough, and it just carried on moving. On this example, you would have made profit if you entered a trade with the smaller pullback, but that's not how the strategy works. So from there, we had to wait for price to pull back on the bigger time frames. So if we go back to the daily 50, I then waited for price, once it had done a big push, to understand where price had exhausted to. So I know as a trader and my 7 years experience on the 2 strategies that there was a point to where price would pull back enough before then carrying on to the downside. And that was going to be the daily 50 EMA. So we use EMAs as barriers where price is going to come back to and then reject. As you can see here, price pulled back once and did not test the daily 50. Price then pulled back for a second time, giving us our double pullback, which is what we always wait for, and that tested the daily 50 EMA. That was then giving us our big barrier and knowing that price had exhausted. Before we entered the trade, we checked our Fibonacci, which is pulled from the biggest push, which was here. That down to there was just over 382 fib and didn't quite hit 50%. So 382 fib is what we want at minimal. That is 38.2% of price pulling back. 50% is really good, and 618, so 61.8% pullback is perfect. Anything more than that, price is looking to roll over and go the other direction. So that is how I knew that price had exhausted enough and we was going to catch that downwards movement. Now we're going to fine tune on the 4 hour and the 1 hour to see if we can gain our entry. On the 4 hour time frame, I now needed some more structure to show that price was rejecting the daily 50 EMA properly and that we wasn't just going to push up and test higher. That, first of all, was looking at a double top on the 4 hour time frame, as you can see here. I had it marked. So we had this double top here once, twice. We was looking for a push. But we do have the 4 hour 50 right below. So price come down, double rejection, tested the 4 hour 50. I am not entering above the 4 hour 50 for a short trade. Price had to be below the 4 hour 50 or above enough where I could get stop loss to entry before it hit that. And as you can see, we had the head and shoulders then play out. So the right shoulder was formed, creating a equal to high on this side. And that is what gives us the entry because we get stop loss to entry before this zone. Now, all we need to put everything together is the entry itself. And the reason I like to use the 1 hour time frame for entries is because it gives us an overall good understanding on what price is about to do, but also I haven't got to be checking the charts every 5 minutes, 15 minutes, 20 minutes. So I can just check it on every hour close and know that I'm going to grab a decent entry. Where if we're on the 15-minute time frame for entries, I'm going to have to be sitting here every 15 minutes checking it all the time, and that's not how I want to trade. That's more of a scalping thing than it is of day trading for me and how I trade. I like to keep it nice and simple and stress-free. So once we've had the two engulfing candles, we always look for a pullback. So the idea is on the MSB strategy is that price will reject the right shoulder and then we look for the mini pullback. Sometimes you can drop down the smaller time frames for this, but we still will enter on the 1 hour time frame. So as we can see here, if I zoom right in, we had the two engulfing candles marked in grey, moving to the downside or the bearish movement. Then we had this bit of a doji high test candle where on the 15-minute time frame price would have pulled back before then going again. Then we had the really large engulfing candle, and that there was my entry. You could have taken the very first engulfing candle, but that's a little bit more of a higher risk move, and our strategy does not take that. So we stick to the strategy and the checklist and go from there. So we entered with a 20 pip stop loss and a 100 pip take profit. So that was giving us obviously our 1 to 5 on this trade. Once the trade was entered, obviously the 20 pip stop loss allowed us to be just above the high and also above the daily 50. So our two barriers we were above. So price would have to break through both barriers before hitting our stop loss. Then I placed my TP just above the trend line on the weekly time frame channel that's been marked. So I knew I didn't want price to be right on where it can be a barrier, so we always bring that back up. So we could have had a 1 to 6 out of this trade, but a 1 to 5 was good because it was smashed instantly. We don't want price sitting around our TP for a day or two for no reason. So don't be greedy. From there, we placed a trade, we let it go. Once price then tested the 4 hour 50 and the neckline of the smaller structure we have here, I put stop loss to entry around 1%. So price had just come in, just broke below the 4 hour 50 and the neckline, and then we put stop loss to entry, meaning this trade was risk free. Then we had a bigger push down into about 2% profit with a pullback. So I then decided to enter for a scaling trade. But due to the scaling trade being held over the weekend, but with the scaling trade that we entered, overnight on the 10 PM open/close on London session, brokers increased their spreads. So where I only had a 15 pip stop loss and price was around entry, the spread was bigger than my 15 pips, meaning I got taken out on the scaling from broker's spread, even though the price was nowhere near it. So that's something to consider when holding trades overnight or over the weekends, that you've got a big enough stop loss to cover the spread that the brokers increase. From there, we just set the trade and away it went. It smashed TP, pushing right through and even pushed through the trend line. So as we are here, you can see we had a 100 pip take profit. It's actually a 1 to 5.1, and the reason I put the 1 on there is always just to make sure that I've made the 5,000 or more. So what will happen is, if I put it dead on 5%, I will make 5,000, but then time I take the broker's commission and the spread out of it, I then only make about 4.8, or depending whatever my risk to reward ratio is. I'm not around the 1,000 mark. So I always do the extra 0.1%, and that will cover broker's fees on the larger accounts, meaning I can actually make £5,000 instead of like 4.8 or 4.9. So just to prove to everyone, we did make 5,000 on that trade, or 5% on the £100,000 personal account. It was not a funded account. There it is. There we go on top, 5,000. Then we have the scaling loss, and then that's another trade I placed yesterday. So we are all truth around here. We're not, you see, I've still got losses in there, even though I've made profit. So we are transparent. So part 2 is going to be, you need discipline towards trading. That is going to be your risk management to start with. So you've got your trading strategy proven, set up, and you're placing trades. But you need to be disciplined in your trading. So first of all, is going to be the risk management itself. That should be 1% on all personal capital that you place, and also on all funded accounts. That is what I do. I'm just explaining to you what I do and how I trade, so you hopefully can learn from that and not do mistakes that I previously done when I began my trading journey. So 1% on all personal capital and 1% on all funded challenges. Once you've passed the funded accounts, then you go to 0.5%, 0.5. Reason for that is we want to be able to keep the trading accounts for as long as possible to make the most returns from them. And the main reason you'll get taken an account off of you is because you're over trading and you're hitting your 5% daily drawdown, or your 8 or 10% monthly or lifetime drawdown. So just keep it at 0.5%. You're not going to make as much off of each account, but you will keep them for longer. And for me personally, over the long run, I've made more money off of funded accounts using 0.5% risk than I have using 1% or 2% risk on them accounts. So that's for me personally, but that's what works. And now this is the big one for part 3. We're going to be going into capital is the hardest part. So I, as a trader, I've had to learn over time that I need to focus on more capital and less trades itself. That meaning that I have to place less trades per month, and I try and make less returns per month on my trading capital, and just grow the amount of capital I have. That's just an easier way for myself and my strategies, and it's a lot easier on risk and also on yourself. You're not stressed every day about trades just because you're trying to risk way too much. So again, that's the hardest part, is grabbing more capital, because we all want to make really good returns really quick off of trading. But the idea is trading is a long-term game. You're after the lifestyle. So if you can trade a £10,000 account, you want to double that every month. But if you've got a £1 million account, you only want to make 1% a month. So there is your whole thing. If you've got a £1 million account and you make 12%, you're still going to make 120,000. Obviously, you've got to take the cut out of on your funded accounts and other bits, but you're going to make the money with the bigger accounts, so you don't even be making silly returns every month. And then finally is to use your personal funds to then buy the trading capital. So I use my personal funds, the money that I make from trading, to buy more trading accounts, and then I then grow my trading capital, and that then allows me to, just in theory, have more capital itself. So instead of, let's say, I just have 100,000 in a trading account and I just should trade that all the time, I can take money out of that account, all the profits out of that account, and then put that back into more funded accounts just to grow the capital itself, because I am thinking long term and I want more capital. So if you've only got £5,000, put half of that in a trading account and use the other half to buy multiple funded accounts. So if you like watching trading educational content, head over and subscribe to the Limitless Trading Club, where I drop a new video every week. Thank you very much for watching. Have fun trading.